Listen to me very carefully. Forget the spot price. Forget the charts. Forget everything you think you know about how the silver market is supposed to work. Because right now, at this very moment, the physical silver market is sending a distress signal so loud, so unmistakable, so absolutely deafening that only the willfully blind could miss it. The premiums have detached. The gap between what the screen says silver is worth and what you actually have to pay to hold it in your hand has blown out to levels we have not seen since the 2020 panic. And in some cases, we have never seen premiums this extreme in the history of the modern bullion market. This is not noise. This is not a temporary glitch. This is the market screaming at you in the only language it knows. This is the tell. This is the signal that precedes every major market dislocation. This is the flashing red warning light that the paper price is about to become irrelevant. Welcome to Finance Monopoly. And today, we are going to decode the premium signal that is about to change everything. If you have been following this channel, you already know we don't chase headlines. We don't parrot the mainstream financial media. We dig into the data that matters, the data they don't want you to see, the data that separates the informed from the ignorant. For years, we have been saying the same thing. The spot price is a fiction. The paper market is a casino. The only price that matters is the price you pay when you walk into a dealer and walk out with metal in your hand. They laughed at us. The institutional analysts, the commodities traders, the financial journalists who have never held a silver bar in their lives. They told us we were paranoid. They told us the COMEX was functioning perfectly. They told us that premiums were just a retail phenomenon, meaningless in the grand scheme of the global silver market. Well, look around now. Look at the premium charts. Look at the dealer websites. Look at the panic in the eyes of the bullion bank traders who are watching their carefully constructed paper castle start to crumble. We were right. We have always been right. And today, the market is proving it in real time. The premiums are not just elevated. They are not just high. They are screaming. They are sending an SOS to anyone with the eyes to see it and the ears to hear it. And if you understand what this signal means, you have approximately zero time to waste. Let me show you exactly what is happening. Let's start with the raw numbers, because this is Finance Monopoly and we deal in facts, not feelings. In a normal, healthy, functioning silver market, the premium over spot price for standard bullion products falls within a predictable range. For generic silver rounds and bars, you typically pay $1 to $2 over spot. For government-minted coins like American Silver Eagles or Canadian Maple Leafs, you pay $3 to $5 over spot. These premiums cover the cost of minting, distribution, dealer margins, and a small profit. That is normal. This is not normal. As of today, the premium on American Silver Eagles is ranging from $12 to $18 over spot price. Let me repeat that. $18 over spot. On some platforms, for immediate delivery, you are paying premiums that exceed 50% of the underlying spot price. Think about the insanity of that for a moment. So the market is telling you that the spot price is $30, but to actually acquire the metal, you need to pay $45 to $48. The premium alone is larger than the spot price was just a few years ago. But it's not just Eagles. Generic silver rounds, the most basic commoditized silver products in existence, are carrying premiums of $5 to $7 over spot. Products that should cost spot plus 1.50 are now spot plus 6. That is a 300% increase in the premium structure. 10-ounce bars are showing premiums of $4 to $6 per ounce. 100-ounce bars, which typically carry the lowest premiums in the retail market, are now $3 to $5 over spot. Premiums that institutional buyers would have laughed at 2 years ago. And here is where it gets truly alarming. Junk silver, pre-1965 US coins. Dimes, quarters, half dollars. These products typically trade at spot or even slightly below spot because of the sorting and processing required. They are the cheapest way to acquire physical silver. Right now, junk silver is trading at $8 to $12 over spot per ounce of silver content. The absolute bottom of the market, the discount bin of the silver world, is now carrying double-digit premiums. When junk silver goes premium, the market is broken. When the cheapest form of silver becomes expensive, there is no cheap silver left. But the retail market is only part of the story. Let me show you what is happening at the wholesale level, because that is where the real terror begins. The premiums you see at the retail level are symptoms. They are the fever that tells you the body is fighting an infection. But to understand the disease, you have to look deeper. You have to look at what is happening between the refiners, the mints, and the dealers. I have sources in this industry, people who have been in the bullion business for decades, people who see the order flows, the delivery schedules, the allocation notices. And what they are telling me is unprecedented. The refiners are backed up, not by days, by weeks, in some cases by months. When a dealer places an order with a refiner for silver bars, they used to receive confirmation and a shipping date within 48 hours. Standard operating procedure. Metal on the loading dock within a week. Now, They are being told 4 to 6 weeks. They are being told 8 weeks. They are being given allocation limits. Sorry, we can only fill 50% of your order this month. The rest goes on backlog. This is not a retail problem. This is not small-time stackers cleaning out their local coin shop. This is a systemic supply crisis at the wholesale level. The U.S. Mint has been rationing Silver Eagle production for years, but it has gotten worse. They claim it's a blank shortage. They claim it's a production capacity issue, but the result is the same. Not enough coins reaching the market to satisfy demand. The Royal Canadian Mint is experiencing similar constraints. The Perth Mint in Australia faced a delivery scandal that exposed the gap between their paper promises and their physical inventory. The private refiners, Sunshine Minting, Asahi, Silvertown, are running at maximum capacity and still cannot keep up. And here is the critical point. The wholesale premium, the price refiners charge dealers above spot, has exploded. This is the premium you never see. This is the cost basis that gets passed on to you. 2 years ago, a dealer could buy 1,000-ounce commercial bars at spot plus 50 cents. That was the industry standard. Today, those same bars are trading at spot plus $2 to $3 in the wholesale market. The premium has quadrupled at the source before it even reaches the retail chain. When the wholesale market goes into premium, there is nowhere left to hide. There is no arbitrage. There is no cheap source of supply waiting to normalize the market. The premium becomes structural. The premium becomes permanent. The premium becomes the real price. And this is exactly what we are witnessing right now. Now, I need you to understand something fundamental, something that will change the way you look at this market forever. The spot price and the physical price are not the same thing. They have never been the same thing. But for decades, they have moved in tandem, close enough that the difference didn't matter for most purposes. That relationship is breaking. When premiums explode like this, it is not random. It is not irrational. It is the market's way of correcting a price that is wrong. The spot price is saying one thing. The physical market is saying another. And when reality and fiction diverge, reality always wins eventually. Now, let me explain the mechanics. The spot price is determined on the COMEX Futures Exchange. It is a paper market where contracts representing silver are traded. The vast majority of these contracts are never settled with physical delivery. They are closed out, rolled over, or cash settled. The price is set by traders who may never touch an ounce of actual metal. The physical price is determined by actual supply and demand. Real buyers, real sellers, real metal changing hands. This is where premiums come from. When there are more buyers than sellers at the spot price, the premium rises until enough sellers appear. In a functioning market, arbitrage keeps these prices aligned. If the physical price gets too high above spot, traders buy paper contracts, take delivery, and sell the metal into the physical market, pocketing the difference. This should close the gap. But arbitrage requires one critical ingredient. It requires that delivery actually works. It requires that when you stand for delivery on a paper contract, you actually receive physical metal. And increasingly, delivery does not work. The COMEX has been struggling to deliver metal on time. There are reports of delays, of quality issues, of delivery locations that are inconvenient to the point of being punitive. The London market is even worse, with delivery times stretching and available inventory shrinking. When arbitrage breaks down, the paper price and the physical price can diverge indefinitely. The paper market becomes a video game, a simulation of the silver market that has no connection to reality, and the physical market becomes the only market that matters. The premium explosion you're seeing is the physical market declaring independence. It is the real price of silver breaking free from the paper cage. And this is the tell. This is the signal that the endgame has begun. For those who think this is unprecedented, let me give you a history lesson. Because this has happened before. And every time it happens, the paper price eventually catches up to reality. March 2020. The pandemic hits. The paper price of silver crashes to $12 an ounce. The mainstream financial media declares silver dead. The algorithms dump paper contracts. The charts look like a massacre. But what happened in the physical market? Complete chaos. Dealers sold out within hours. Websites crashed from traffic. The mints went on allocation. And the premiums exploded to $10, $12, $50 over a $12 spot price. The real price of silver was $25 to $30, while the screen said $12. And what happened next? Within 6 months, the paper price rocketed from $12 to $30. The paper price caught up to where the physical market had already priced reality. February 2021, the silver squeeze. Retail investors organized online attempted to drain the COMEX by buying physical silver in PSLV. The paper price moved modestly, from $20 to $30. But the physical market went berserk. Premiums on Eagles hit $15. Generic rounds were $8 over spot. Monster boxes were sold out everywhere. The waiting time for delivery stretched to weeks. Again, the physical market was screaming that the paper price was wrong. And eventually, silver touched $30, validating what the premiums had been saying. Now look at today. We have premium levels matching or exceeding those crisis periods. We have dealer shortages across the board. We have wholesale backlogs at the refiners. We have mints on allocation. Every single indicator that preceded the 2020 spike is present. Every single indicator that preceded the 2021 surge is flashing red. But there is one critical difference. In 2020 and 2021, the demand was primarily retail and investment. It was stackers and silver enthusiasts. Important, but not existential. Today, the demand is industrial. Today, the demand is strategic. Today, the demand is coming from entities that cannot accept cash settlement. They need the metal. They need it for solar panels. They need it for electronics. They need it for military applications. When industrial users start competing with investors for a shrinking supply of physical metal, the premiums do not just spike temporarily. They become permanent. They become the new floor. This is not 2020. This is not 2021. This is bigger. So why hasn't the spot price moved? If the physical market is screaming for higher prices, why is the paper price stuck? This is where the manipulation becomes impossible to ignore. The paper market is controlled by a small number of large players, the bullion banks, the swap dealers, the entities that hold massive concentrated short positions in silver futures. Their incentive is to keep the paper price low because they are short. Every dollar silver rises costs them billions, so they use their market power to cap the price. They sell paper contracts in massive quantities during low liquidity trading hours. They trigger stop losses and margin calls. They paint the charts to look bearish. They do everything in their power to convince you that the rising premiums are meaningless. But there is a problem with this strategy. You cannot eat paper. You cannot build a solar panel with a paper contract. You cannot deliver a futures contract to a factory in China that needs silver for their manufacturing process. Every day that the paper price stays artificially low, the physical market tightens further. Every day that cheap paper discourages new mining investment, the supply deficit grows larger. Every day that industrial users lock in physical supply at premium prices, there is less metal available for the next buyer. The manipulation is not preventing the reckoning. It is ensuring that when the reckoning comes, it will be catastrophic. The banks are digging their own grave. They are suppressing the price of something that is running out. They are shorting a market where the buyers increasingly demand physical delivery. They are playing checkers while the Chinese play chess, and the premiums are the scoreboard. The premiums are showing you, in real time, that the paper kings are losing. Every dollar of premium over spot is a vote of no confidence in the paper market. Every backlogged order at a refiner is a vote of no confidence in the COMEX. Every empty shelf at a coin shop is a vote of no confidence in the system. The votes are being counted, and the paper market is losing in a landslide. Let me tell you what the smart money understands that the average investor does not. The smart money does not look at the spot price. The smart money looks at the premium. When premiums are low, it means physical supply is abundant. It means the paper price is a reasonable approximation of reality. It means there is no urgency. When premiums explode, it means physical supply is tight. It means the paper price is a lie. It means the window to acquire metal at reasonable prices is closing. The premium is the truth serum of the silver market. It cannot be manipulated by paper contracts. It cannot be suppressed by algorithm trading. It is pure supply and demand, buyer and seller, metal and money. Right now, the premiums are telling you to buy. They are telling you that every day you wait, the real price goes higher even if the spot price stays flat. They are telling you that availability is more important than price. And the smart money is listening. I'm hearing reports of high net worth individuals placing orders for thousands of ounces and not blinking at the premium. They are not negotiating. They are not waiting for a dip. They are securing metal. I'm hearing reports of family offices, the investment vehicles of the ultra-wealthy, diversifying into physical silver for the first time. They see what's coming. They understand that when the paper market fails, only physical holders will be made whole. I am hearing reports of international buyers, particularly from Asia and the Middle East, acquiring silver through private channels to avoid the public markets entirely. They are paying premiums that would make a retail stacker cry. And they do not care. They want the metal. This is what it looks like when the smart money moves. They don't wait for confirmation from CNBC. They don't wait for the spot price to validate their thesis. They look at the premium. They understand what it means, and they act. The question is, will you act with them, or will you be left holding worthless paper while they hold the real thing? Let me paint the picture of what happens next, because the pattern is clear and the outcome is inevitable. Stage 1. We are here now. Premiums explode while spot price stays suppressed. The paper market and physical market diverge. Retail investors are confused. Mainstream media is silent. Stage 2. The divergence becomes too large to ignore. Industrial users start bypassing the paper market entirely, negotiating direct deals with miners and refiners at prices far above spot. The official price becomes a joke that nobody believes. Stage 3, a delivery failure. Someone stands for delivery on the COMEX or LBMA. The metal is not there. Or it is there, but it is not the right quality or not in the right location, or there are administrative delays. The failure makes headlines. Confidence collapses. Stage 4, the paper price gaps up violently to meet reality. We are not talking about 5% moves. We are talking about 20%, 30%, 50% overnight gaps. The shorts are annihilated. The banks face existential margin calls. The system seizes. Stage 5, the new equilibrium. A price that reflects actual supply and demand. A price that incentivizes mining investment. A price that rations demand. A price that could be $50, $75, $100, or higher, depending on how badly the system was distorted. The premiums are telling you that stage 1 is ending. The premiums are telling you that stage 2 is beginning. The premiums are the early warning system, the smoke detector going off before the flames are visible. You have a choice right now. You can look at the spot price, believe the paper market, and wait for confirmation that will come too late. Or you can look at the premiums, understand what they mean, and position yourself before the repricing event. The premiums are screaming. The physical market has detached. This is the tell. The only question is whether you are paying attention. So here is what I need you to do. Do not look at the spot price anymore. It is a distraction. It is a manipulation. It is a number on a screen that has no relationship to the metal you need to hold. Look at the premium. Track the premium. The premium is the truth. Do not wait for the premium to go down. It is not going down. The conditions that are causing these premiums, the supply crisis, the industrial demand, the paper market manipulation, these are structural, these are permanent. The premiums are not going back to $2. Do not be afraid to pay the premium. The premium is not a penalty. It is the real price. When you pay spot plus $50, you are not overpaying. You're paying the actual market value of physical silver. The spot price is the one that is wrong, not the premium. If you can find silver, buy it. If your local dealer has inventory, buy it. If an online retailer has stock, buy it. Do not hesitate. Do not negotiate. Do not wait for a better entry point. The premiums are telling you that silver is scarce. The premiums are telling you that the system is breaking. The premiums are telling you that the transfer of wealth from paper holders to physical holders is about to accelerate. And when that transfer happens, there will be two kinds of people, those who listened to the signal and those who wished they had. This is finance monopoly. We told you the spot price was a lie. We told you the paper market was a casino. We told you that premiums were the truth. Today, the market is proving us right. The premiums have detached. The physical market is speaking. The tell is on the table for anyone with the courage to read it. The spot price is noise. The premium is signal. And the signal is screaming. Stack accordingly. I'll see you in the next one. If this video helped you understand what's really happening in the silver market, hit that subscribe button, turn on notifications. Share this with someone who still believes the spot price is real. The more people who understand the premium signal, the harder it becomes for the paper manipulators to maintain control. Knowledge is power. Physical is wealth. Stay stacked, stay informed, stay ready. Finance Monopoly out.